Once again, good morning. I'm Ralph Serpe with the Adams County Community Foundation, and welcome to our 2021 investment briefing. Joining us today to give you a clear picture of the Community Foundation's endowment is Community Foundation Treasurer and Investment Committee Chair, Jim Kampstra. Hi, Jim, how you doing? And from Brown Advisory, James Stierhoff and Jonathan Price. And we'll hear more about and from them in just a bit. There are over 250 separate charitable funds at the Community Foundation, and each fund is governed by its own fund agreement that gives that fund a name, a purpose, and identifies the grant maker or the advisor. We run some pretty powerful software here, and we account for each charitable fund separately. But we pool the dollars together for investment purposes, like one big charitable mutual fund. The investment return on that endowment helps fuel everything from our Adams County Grants Program, initiatives like At Home in Adams County, over 100 scholarship awards, and more than 80 nonprofit operating endowments, including our own. Recent projects that have been supported by this endowment include Mercy House, Community Media's Broadband Initiative, and yes, even the Giving Spree. They all rely on the success of the Community Foundation's endowment and how it's invested. Today, we're going to be looking at the Community Foundation's endowment in a number of ways. We're going to look at our investment return versus our spending rate. Those are two different things. Jim Kampstra is going to take us through asset classes, ranges, and targets. That's based off of our investment policy. And then James and John at Brown Advisory are going to look at the role of our portfolio managers, our asset allocation, and our rebalancing, performance summary, a peer analysis, and then we'll open it up for your questions. If you're just joining us, thank you. My name is Ralph Serpe with the Adams County Community Foundation, and this is our 2021 investment briefing. So let's begin with the difference between investment return and spending policy. Investment return is the total of what the endowment earns or loses in any given time period. So our endowment is invested, and that investment has an expected return. And that return can be positive or negative. And it's based on the underlying investments that are part of the endowment. Our spending policy is how much our individual charitable funds can grant or spend each year. That rate is set by our board of directors with input from our investment committee and investment managers. And it's always a positive number. Our current spending policy rate averages the fund balance over the previous 5 years and multiplies that average by 4.5%. So it's important to remember the difference, because any investment return beyond fees and spending payout stays in the fund, which enables it to grow. So the following year, the payout can be higher. That's the theory we're going with. The board sets that spending. The Community Foundation board sets that spending rate each year, and it has been at 4.5% for some time. The board also approves the Community Foundation's investment policy and charges its investment committee to oversee the endowment. And so joining us next is Jim Kampstra. You can unmute yourself, Jim. He is on the board. He is our treasurer and the investment committee chair. Jim is a wealth advisor and owner of Kampstra Wealth Management here in Gettysburg. Over the past 12 years, Jim has earned numerous industry certifications and accreditations, including the Certified Investment management analyst designation, and he's a CFP, a certified financial planner. He's actively involved in this community, serves on the board of Totem Pole Playhouse, and is the treasurer for the Community Foundation. And this morning, Jim is going to talk about the role of the investment committee and the endowment's asset classes and asset allocation. Jim?
Thank you, Ralph. Good morning, everyone. So as Ralph said, I head up the Investment and Finance Committee. You have a couple of different responsibilities, but one of our main ones is fiduciary responsibility or legal responsibility, to oversee the portfolio and make sure the endowment is invested prudently. Of course, we've developed policies, to outline how we want to do that. The investment policy being the main one. And then also equally as important is, make sure we're following that investment policy over time. A lot of people create these policies and just sort of put them on the shelf. Very important to make sure we're monitoring it and following it over time. So Ralph put up some ranges up there, but before I jump into that, just wanted to hit on a couple of things in the investment policy. I will note that if you'd like a copy of it, you can find the full investment policy right on our website. But one of the main things that goes into this is time horizon. Always like to hit on that because, as humans, we always sort of like to look at things through our own lens. We've all been told when you're young, you want to be aggressive, buy stocks. As you get older, you want to be more conservative, see things be more stable. And, we really need to think differently when we're talking about the community foundation. Our time horizon is infinite. We will be here forever. We want to provide for today's needs of the community, but we want to be able to do that 100, 200, 1,000 years from now as well. So definitely looking at the long-term approach. Also equal important, the total return approach is what we follow. As Ralph just hit on, investment return versus spending. We're giving out about 4.5% annually each year. I think a lot of people in their mind imagine, we buy stocks and bonds and things to try and earn a yield, of about 4.5%. We want dividends and interest, coming in every year so that we can give that money out. That's actually not the case. The total return approach, we are, looking at the yield, the interest, the dividends we get, but equally important is the price appreciation. We want to see the share prices growing over time as well. Very important, especially in today, environments like today. The Federal Reserve has dropped interest rates very close to zero. If we were trying to design a portfolio that was, providing a yield of 4.5%, we'd be taking a lot of unnecessary risk. Whenever the 10-year U.S. government bonds pay 1.5%, very, very difficult. A lot of risk to get a higher return. So just keep that in mind. We're looking at both appreciation plus the yield. And then of course, what is our target return? Basically it's a formula. On a 5-year rolling average, we want to see our returns equal or exceed, our spending rate, currently 4.5%, plus, inflation as measured by, the CPI, Consumer Price Index, over this past year has been right about 1.4%. So, right now our target is, just under 6%. However, as the economy changes, as inflation changes, we change as well. So, that being said, sort of, jump right into that slide, the asset allocation. How are we going to get that target return? The top part gives you really the high level. We want to see 70%, give or take, in equities or the stock market. Also about 30% in fixed income or bonds. Again, important to have both there because, we want to make sure we're able to provide for today, the current spending rate, the fixed income helps with that. The stock piece, obviously, we want to see our spending ability to increase over the future. So that's why we have stocks. Of course, we do give some ranges there. You can see the minimum, we give a 5%, to the down or upside. And, we just want to put some discretion or some, flexibility in there so that our managers can take advantage of the different market, different economic environments. Sometimes we may want to be a little more aggressive when it's warranted, sometimes a little more conservative. And then, of course, within each of those high level categories, the bottom part there shows you the, more the nuts and bolts. 70% stocks is kind of broad. There's lots of different types of stocks. So we further define that, 45% target in U.S. large companies. Large companies tend to be more stable over time, more likely to survive the next economic downturn. So, that's why it's going to have the largest, target allocation. Of course, smaller companies, medium-sized companies, international stocks, they tend to be a little more volatile from year to year, especially when we have, economic, issues. That being said, over the long term, they can provide better returns, and really just comes down to diversification. Sometimes large companies and small companies, or US versus international, are performing differently. So by including all those different categories, it helps to sort of smooth out the returns over time. Of course, we also give ranges on those categories. Again, depending on the current environment, we may like one a little more than the other, and we do want to give our managers discretion there. But at all times, we should see about 70%, give or take, in stocks. Of course, on the fixed income side, also some flexibility there. Really the main goal of the fixed income is provide stability, ensure we can meet our current spending rate. So you're not surprising the target is 30% high quality investment grade type bonds. That being said, we do like to give some flexibility there, so we can, hold some cash if wanted, or hold some riskier bonds. But again, in general, it's going to be right around 30% and pretty safe, type bonds. So, most, investment studies over time, tell you the single most important factor to what your long-term results are going to be is your asset allocation. So again, very important that we have that defined, and, we do periodically review it and adjust it, but, stays pretty similar to this. So if you want to jump to the next slide, Ralph, also important, benchmarking. We want to make sure that, our investments, the portfolio is performing in line with the market, what we're seeing out there. So of course, basic target of 70% equities or stocks, 30% bonds, that's how we want to benchmark our portfolio. Really the way we do that, of course, is to find market indexes or indices. The S&P 500, the one mentioned there on the screen, really is, basically a gauge for large US stocks. If you're not familiar with it, basically just measures the performance of 500 very large US companies. All companies you would all recognize, like Apple, Procter & Gamble, Johnson & Johnson, Google. If we can see how those companies are performing, that gives us a pretty good idea, are we performing similarly, better or worse? Of course, we don't want to benchmark ourselves to just the S&P 500. As we saw, we have, stocks, bonds, US, international. So that's why we create that blended or composite benchmark, to sort of, tailor in the specific underlying, asset classes in the target. If you want to jump to the next slide, Ralph. So, what is our benchmark? Not a coincidence, basically, mirrors our target allocation. 45% the S&P 500, our large US stocks, 30% in the Barclays US Aggregate Bond Index, just measures the performance of all the bonds out there. And then of course, for the underlying, international stocks, we use the MSCI EAFE, Europe, Australasia, and Far East, measures international markets. And then the Russell 2000, smaller company stocks, and the Russell 2500 for your, medium-sized companies here in the US. So, basically, for those of you who aren't familiar, there are a lot of investment vehicles out there today. We as a community foundation could just go ahead and buy these specific indexes at these weights, just capture the market rate of return over time. So important that we use that as a gauge to measure our managers, by giving that the flexibility, letting them sort of move things around with those ranges. This is a great way to measure, are they adding value? Are they earning their keep, so to speak? So definitely important to monitor that. So that's the last slide, but I just wanted to hit on two additional details. Also important, one of the fiduciary responsibilities is to, fees and expenses, ensure they're reasonable. Just want to, throw out the plug that, of course, if you partner with the community foundation, not only do you get our investment and finance committee, our oversight of the portfolio, but you also get to benefit from our size. As our size has grown, we're nearly 20 million in endowment assets right now. We've been able to negotiate serious discounts to our fees. So, by partnering with us, investing through us, you get to benefit from those, discounted fees as well. And then last, all of this basically that we went through sort of, dictates how do we invest the portfolio. Obviously the next step is, choosing the actual investments or the managers to build out that allocation. We can work with more than one manager. Historically, we have owned a fair amount of stock in a local bank. last year with everything going on with COVID, and interest rates, the decision was made that it was time to go ahead and divest that stock. So at this point in time, 100% of our endowment is managed by Brown Advisory. And, our job obviously is to make sure, their performance is good. They're following the investment policy. Really just hold their feet to the fire, make sure we're getting the results we want. And I guess this is my 5th year as treasurer. I will say it's been a great relationship working with Brown Advisory. From my point of view, they've been doing a great job. With that, I will go ahead and turn it over to James and John.
Well, I'll jump in there, Jim. Thank you so much. Hey, folks, remember Jim Kampstra is the treasurer of the Community Foundation. He chairs the Community Foundation's investment committee. At a community foundation, it is quite common to refer to us as a 3-legged stool: money in, money out, and that third leg is the investment endowment side. So when you think about, for those of you that are parts of organizations, our investment and finance committee led by Jim thinks this stuff is actually fun and interesting, and they pay attention to it. So it is my pleasure to introduce James Stierhoff and John Price. And I'll start with James. James is a partner, portfolio manager, and serves as a member of the endowment and foundation investment team and sustainable investing leadership team. James has been with Brown Advisory for 11 years, and in his role as portfolio manager, he advises and manages portfolios for individuals, families, endowments, and foundations, community foundations like ours. In his role on the sustainable investing leadership team, James helps in the review and selection of ESG, sustainable and impact-focused managers on the external investment platform. Now, when I say a line like sustainable and investment-focused managers on the external management investment platform, that line was written for me. That's not coming out of my mouth, but we'll have James go look at that. With James is the Community Foundation's long-time investment ally, consultant, and advisor, John Price. A dozen years ago, John and Brown Advisory believed in the Adams County Community Foundation and our ability to grow this endowment. When a local bank said no to managing our then very small endowment, Brown said yes. So James and John, the screen is yours.
Ralph, thank you so much. Jim, thank you very much. This is John, and I would start off by saying it has been, and I don't use these words lightly, these adjectives, a pleasure and a real honor to have worked with Adams County Community Foundation since January 2009, as Ralph pointed out. It's been a great ride, and there is so much more to go, as I think you are going to hear and as you understand. We thought it might make sense to share with you just a quick, brief thumbnail sketch of Brown Advisory to give you an idea of how we think about and approach our partnership. And again, I want to emphasize this is a partnership that we have with the Adams County Community Foundation. As background, we are headquartered in Baltimore. We were created within the old Alex Brown and Sons. Some of you may remember Alex Brown and Sons was at the time of its purchase by Bankers Trust, the oldest investment banking firm in the United States. So our Little Brown Advisory was created within Alex Brown back in 1993. And we took ourselves private in 1998, right after Bankers Trust bought Alex Brown. In the 28 years since we had our first employee and our first dollar of assets, we've grown to almost 120 billion in assets under management. And that equates to about 750 employees in 13 offices here in the United States, in Europe, and also more recently in Asia. Now, more germane to ACCF, we began an effort internally a number of years ago to dedicate resources to building relationships and managing assets in the nonprofit world. So this would include 501c3 nonprofit endowments, private foundations, and importantly, community foundations such as ACCF. And we felt that this aligned perfectly with our view that we as a company and we as individuals have an obligation to the communities which we live in and work near to give back. So as you can see from the screen, we created this endowments and foundations unit within Brown several years ago. We now have upwards of 7.2 billion in assets just in this sector. And I also want to point out of the 120 billion within Brown Advisory, about 25 billion of that are what we call mission aligned assets. My colleague James is going to walk through sustainability and mission alignment in just a moment. So again, the way we view what we're doing is a partnership. We work together in any number of ways. Obviously, on the investment side, that's our main focus. But importantly, really try to understand Adams County Community Foundation, where it's been, where it is today, but most importantly, where we're going. As Ralph mentioned, I've been fortunate enough to be involved for 12 years now. And I was computing last night, Ralph, the compounded annual growth rate of the assets under ACCF's umbrella. It comes to 43% compounded annual growth. 43% compounded annual growth rate. If ACCF were a stock, you can bet that ACCF would be in our portfolio with a growth rate like that. So James, I'll turn things over to you maybe to talk about the portfolio, mission alignment, and sustainability.
Great. Well, thank you all and appreciate the time. You know, it would not be an investment briefing without talking a little bit about what happened last year. And, you know, as I reflect on the sort of long, strange trip we've all been a part of, you know, I think about on Monday, my second daughter will be celebrating her first birthday. And I vividly remember moving the car at the hospital and watching them set up the COVID tents outside the ER at the same time. And you know, while the market has surely responded and muddled through this and actually done quite well last year, as did the community foundations and portfolio, I'd certainly just like to acknowledge the fact that there's still a pretty big disconnect between Wall Street and Main Street. And there's a lot of people out there that are still having a hard time from an employment standpoint, from a health standpoint. And it's organizations like yours that step in and really help make a difference during times of need and times of stress. So it's been a pleasure to help support you all in our small way. But, you know, last year, I don't need to belabor these points too much, but clearly we saw a significant market decline in really the month of March as everything set in with COVID and the lockdowns began. And last year was probably one of the most active years in portfolios that we've had in a long time. And we had to make a lot of decisions in the year. And, you know, information, while there's plenty of it, at times, there was also a lot of uncertainty and a lot of fear to navigate last year. And as Jim laid out, I think quite nicely, our long-term investment policy statement is what helps keep us focused, keeps us thinking further out than a day, a week, a month. Again, we're thinking years and years out. And that helps give us the guide rails that we need to stay focused on making good investment decisions on your behalf, even during periods of great stress and unknown. And, you know, in the first, you know, more than half the year, it was clearly anything that had exposure to, you know, online sales that did well. If you're like me, Amazon and grocery delivery are the biggest tickets on my credit card statement and remain so today. And those were great places to invest. And we had exposure to many of those segments, but as Jim also nicely laid out, we run a diversified and balanced portfolio. And we were quite nimble in moving in and out of different pockets of the market where we saw more attractive opportunities, continually rebalancing the portfolio, leaning into undervalued investments, peeling off some of our more overheated investments that have done quite well, and really just trying to add value along the way. Clearly at the latter half of 2020, right after the election, we saw some very exciting news related to the vaccines, and rightfully so, the market responded accordingly. And we saw segments of the market like small cap stocks, like international stocks, like value-oriented strategies, things that had largely been out of favor for the first 10 months of the year, really rally significantly, as you see here in this column, the fourth quarter of 2020. And again, we run a balanced portfolio. We have exposure to those segments, and we're pleased with how the portfolio participated in that rebound. And I'll just touch briefly on where we stand today from a positioning standpoint before telling you a little bit more about the performance. As you'll see on this page, we have our targets that Jim articulated earlier and where we stand today. So I mentioned being active in rebalancing, and really what that means is when the market was down, selling bonds and buying stocks. And when the market got overheated, essentially doing the same thing the other way, selling some stocks and adding more to bonds. The one reality we're faced with today is definitely a low interest rate environment, and the Federal Reserve did a phenomenal job of getting rates low very quickly to inject stability into the market. But as a result, it makes it a little harder to earn an attractive return in fixed income. So we're not overweight fixed income any longer. We actually were going into 2020 because we felt equity valuations were overheated, but we're fully invested today, and that is our charge. In the summer, sort of in the September time range, we actually leaned pretty heavily into small cap stocks. They were trading at a very, very significant discount to their historical valuation, and we saw it as an opportunity to lean in there. Over the past few months, that's proven to be a good allocation decision, and we continue to think there's more room to go there, hence our overweight to that segment. So probably what you all care most about is the actual results for the Community Foundation portfolio. And this is a busy page. Think of this as our scorecard. And we want to measure ourselves, and we want to measure our investment decisions, our allocation decisions, our strategy selection decisions, a variety of ways, and we try and use this page to help us do that. You also see at the bottom the various benchmarks that Jim explained for us earlier. And looking at the trailing 12 column, trailing 12 months, so this represents 2020. Really pleased to see some significant outperformance from our fixed income strategies, up almost over 10.5% in a calendar year. Within our equity bucket, up 20.5% across our equity strategies, outperforming a global diversified equity benchmark, which was up about 16%. The very bottom line, again, is what matters most. Net of all fees, how did we stack up to our benchmarks? 18% on the year. This is obviously exceeded the spending rate of 4.5% plus CPI. and really pleased to see it exceeded our blended benchmarks again that we're using as measuring sticks for ourselves and the decisions that we're making on your behalf. Really importantly is going out even longer term too. We've been pleased with the long-term performance of the portfolio and its ability to really generate some meaningful value for the community foundation. Within this portfolio, we're actually using more than half of the strategies that we've selected are consumers of environmental, social, governance research and sustainability research, and this is because we think it makes for better investments. Whether our equity research analysts and portfolio managers are using that additional research and analysis to identify potential ESG risks and determine whether management teams are managing those risks, or if they're taking it one step further and looking for businesses that are accounting for sustainability drivers within their investment thesis. Is a company focused on their consumption of, for instance, natural resources in their manufacturing process? Are they using a less water-intensive manufacturing process that results in a better impact on the community, a better impact on the environment, but also importantly, results in a better impact to the bottom line of that business and saves money and makes it a higher margin business and better investment long term. This is an added layer of research that many of our managers we've selected are incorporating into their deep fundamental bottom-up research process. So clearly last year and longer term, I think it has been a good market for active management, for stock picking, and I think the added ESG research element that many of the strategies are incorporating has been very beneficial to the community foundation. We also want to measure ourselves against our peers. So this is a snapshot again of our portfolio net of fees versus two peer groups. One, this is our balanced institutional composite at Brown Advisory. So this is a group of similarly allocated nonprofit clients that were managing their endowments and foundations and how they did over the trailing 1, 3, 5, 10 years. And I think I'm quite pleased to see Adams County exceeding our peer group internally, and as well as compared to other community foundations. This peer group is compiled by the Finance Administration and Operations Group for Community Foundations. And it is an amalgamation of many, many community foundations around the United States and their performance results over time. And we stack up quite well and really pleased to see that. At the end of the day, dollars and cents matter a lot. And it's remarkable to see, since the inception, going back again to 2009, how much the endowment has grown. And it has been a true team effort. Frankly, half of this growth in the portfolio has come from Ralph, leadership, staff, board at the community foundation, raising assets and growing the endowment. And the other half has been from market appreciation and income generation within the portfolio. And, I know I speak for John and the rest of the team at Brown Advisory when I say we really are very excited to be partnered with you and share your vision of growing this even further. Ralph and us were talking the other week, and we threw out $300 million as our target to grow this to. And what I get fired up about is just knowing that as the base of the portfolio, the denominator grows, that 4.5% spend rate translates into more and more dollars that you can invest in your community to support the people that need it. And I think this is one of the most rewarding things about my job is truly, you know, viewing us as an extension of your organization to help you do what you need to do and be there partnered with you. So let me stop there, and happy to take any questions on the portfolio performance or anything else.
John, I'm going to, James rather, I'm going to jump in and ask a couple of clarifying questions. You can stop sharing your screen so we can, I can see the chat side of it. But
Perfect.
let's talk about the discipline of rebalancing. So what we say to you as the Community Foundation is that what is in our endowment portfolio, our endowment pool, is endowment dollars. So it's the reason why pass-through money does not come into that endowment pool. And rather than say a foundation that's created with one gift many years ago, we have that added variable that there's always new money coming in. And of course, over the course of the year, we have grant money that goes out at the beginning of the year, the middle of the year, the end of the year. So tell me about your approach to rebalance, this idea that you're going to help us grow this endowment by selling high and buying low. And how do you do that within this endowment?
Yeah, great question. So, you know, in periods like March of last year, when equity markets sold off so significantly, that portion of the total portfolio drops, and the respective portion of the stability assets, your bonds and cash, rises. And because we have the asset allocation ranges that we're charged with adhering to, you know, we can let things drift to a certain extent. We can get more defensive. We can go overweight bonds if we feel that there is a period of stress on the horizon, or if equity valuations are too stretched, and we do that often. But on the other hand, we need to make sure that we're staying invested and focused on the long term. And the fact that the time horizon of this portfolio is so long, the fact that we know you are continually adding to it and building it, and the fact that we have our target allocations is what keeps us focused on, frankly, in periods where it feels a little uncomfortable to do so, looking for attractive investment opportunities where we think we can earn a better return on your behalf, sell some of our bonds, reduce our stability bucket, lean into weakness in the market in a risk managed way. I mean, we were not swinging for the fences. We did not go and buy Carnival Cruise Lines. We did not go and buy a bunch of, you know, hotel stocks. And frankly, if you did that at exactly the right moment, you might have made a fair amount of money. You also might have risked a fair amount of money. So, you know, we're not trying to swing for the fences. We're just trying to make thoughtful, informed decisions from an allocation standpoint and from a manager selection standpoint, knowing that within each of their portfolios, they're making the same decisions at the individual stock and company level.
So, James, tell us the difference between an active management philosophy and a passive managed philosophy. Where are we now, and where have we come from over the last year or so?
Yeah. So passive management is essentially you buy an indexed ETF or mutual fund, and it is attempting to mirror and track the performance of the index it is following. So you can go and buy an S&P 500 ETF that will try to mimic the composition and return of the S&P 500 index. And frankly, for the better part of the past decade, that was a really good strategy. Passive did quite well. What we saw, however, in a year like 2020 was when panic and fear set in. There are more mispriced opportunities and more irrational behavior in the market, and it actually ended up being quite a good period for active management, which is our managers that we're selecting, rather than buying 500 stocks in their portfolio, are doing very deep research and analysis on companies within their investment universe to determine which ones they think are the best stocks in that universe of 500 or so, and which ones they think will be able to generate more value and outperform over the long term, and perhaps only own 30 or 40 of those. And today the portfolio is all actively managed. And now we don't have the entire portfolio in 30 stocks. We have, a handful of strategies that are each doing the same thing, again, within their mandate. So within small cap, we have a manager picking 50 or 60 stocks. Within large cap, again, 2 or 3 managers picking 30 to 50 stocks. And we add it all up and hope that they continue to add value through their research and through their stock selection, which they've certainly done a very nice job on your behalf thus far. And this is something that John and myself and the team at Brown Advisory monitor very closely. Are those strategies doing what we hope they would? And if not, there's reason to move on and make a change. Or perhaps if we're entering a market environment where we don't think it's favorable for that type of a strategy, reducing that, adding to another. These are the types of decisions we're making throughout the year for you all.
Great, thank you. In the same way that many of our grant making strategies, what we do with this endowment over time is very much the same. Actively managed grant making is the same thing that our investments are doing. Folks, if you're with us and you'd like to ask a question to Jim Kampstra, or anything about our investment committee and how that operates, or anything to John Price or James Stierhoff at Brown Advisory on how thoughtful investing has helped build this portfolio over time, please type that question into the participant chat box, and I'll go ahead and ask them. While I'm waiting for you to ask your good questions, I'm going to ask John or Jim or James again about this idea of a rolling investment horizon. I am hopefully one day soon nearing retirement. So my retirement assets are geared toward my actuarial age of 84 years and 6 months. And that's what I'm gunning for. What's the actuarial age of this endowment and this community foundation?
We're building the 529 plan, and I think Jim laid it out quite well. I mean, the time horizon, is in theory infinite unless we solve all the world's problems, and there's no need to have additional support for community members, which I guess we could hope that would be the case one day. But until then, the plan is to grow and manage this portfolio to be there to support folks today and 100 years from now and even longer. Jim, I'll let you add to that.
Yeah, Jim, what does that mean from a community foundation standpoint, that the investment horizon is always rolling out 7 to 15 years?
Yeah, I mean, it's just even more important how we, pick our target asset allocation and manage it. It's as James already hit on a little bit. People tend to get emotional, especially when it comes to their money. We're just emotional creatures, and when we go through those really, tough periods like we saw early last year, most people are thinking, "Wow, this is my retirement. I need this money in say 10 years. I better hurry up and stop the losses, stop the bleeding." It's just sort of our normal human emotional reaction. So, I mean, just again, very important that we always remind ourselves the time horizon, the investment policy, and that's how we're, with confidence able to make the decisions like we did last March of, stocks are down 35%, maybe going lower. Nobody understood this COVID thing at the time. But, we had the conviction to go ahead and, add to stocks while they're down. And just amazing how, doing that over time consistently, 20, 30, 50 years into the future, we're going to have better results because of it.
Great. I don't see any questions in the chat box. I'm now scrolling through the, here we go. I do have, thank you, Linda. Question comes from Linda. It says, are fees fixed going forward, or as the endowment grows, will the percentage be adjusted? And Linda is suggesting that it should be adjusted in a downward view. So Jim, I'm going to let you answer that question. Thank you, Linda.
Sure, very good question. And it's definitely not a static thing. As the one slide showed, 12 years ago when we started, we had under $400,000. I can assure you Brown was charging a higher investment management fee at that point. As we get to different levels, bigger and bigger, our fees have come down very nicely. And that's, sort of human nature. Brown, obviously is in business to make money. So as part of our job, again, at the investment and finance committee is benchmarking, what are other people charging for similar size investment pools. And as part of our job is making sure those fees do go down over time. And I believe, as soon as we hit 20 million, hopefully this year, we'll see another reduction. So very good question. And, same thing with us as a community foundation, we have a little bit of a fee in there, to make sure we can do the good work for the community. And as the assets grow, that fee, should trend down over time as well.
Yeah. So thank you, Jim. And thank you, Linda. It's so right now our investment management fee to Brown Advisory is 60 basis points. That's 0.60, under 1%. That's separate from the administrative fee that the different funds are assessed based on the type of grant making that they do. And with both of those, as the community foundation grows, we enjoy an economy of scale behind that. And so, as Jim mentioned, those fees come down. Patty Schwartz asks, can you compare the community foundation fees, including Brown's fees, to bank fees for management of assets and endowment? I can tell you that before I push it off to them, you'll see in that 12-month period and in that 12-month period, 12-year period since inception. Since inception, this endowment has returned on an annualized basis 10.6%. And we're going to pay an investment management fee, and we're going to pay an administrative fee to the community foundation. And it's not always about how small that administrative fee is. I would much rather pay 2% of an admin fee to get 10.6% than maybe a 1% fee to get 4 or 5%. So that's what I will compare. Sometimes in the management of in trust assets, if any folks around the square here have charitable assets invested in trust or another institution, let's share how we've been doing over the past dozen years. let's share our asset allocation and our targets and see overall, not just the investment fee for the people that are managing it, but the actual net return that's come back to the fund and what that's purchased you. So that's my defensive hat is now off, Patty. Thank you for asking the question. One of the things that we do not do at the Community Foundation is tuck those fees away. So when you have a fund at the Community Foundation, you see your beginning fund balance, you see the gross investment return, you'll see what Brown Advisory is charging to the pool, and you'll see what the Community Foundation is assessing to the fund for what it does. So we show you everything. And sometimes it's really, let me put a little star next to that. Sometimes when you're in other mutual funds, you may not see everything, but we show you as much as we see. And I always challenge folks to go back, particularly when you're invested in the investment product of the company that's managing your investment. You're not going to see all the fees. So Patty, I can't answer that fund, so I'm gonna do what's best and kick it to James.
Yeah, no, great question. And I think, being laser focused on this when comparing different groups is really important. So a couple things I would throw out. John told you a little bit at the beginning about the bigger footprint of Brown Advisory, $120 billion. 40% of those assets are in institutional strategies that we manage internally. We have 50 equity research analysts and portfolio managers managing strategies that are available in mutual funds and separate account format. We have the ability to use those strategies in our client portfolios like yours, and we do. And we pick the ones that we think are best and going to do best for you and play the role we want in the portfolio. We can also pick an external strategy if we feel that is a better fit. Importantly, if we use an internal strategy, no additional fees are charged. You're already paying Brown an account level fee. So you get that for free, essentially. Unfortunately, I've looked and combed through many statements of other firms over the years, and that's not always the case. In some cases, you're paying an account fee and you're paying additional fees for other products. So that's certainly something that we try and bring to the table as part of our value proposition is, by the way, we have a really impressive, robust institutional research effort, and we can get you the solutions we need at a very low additional cost. Jim also talked about the economies of scale. And again, I think it's important to think about where you sit within the broader effort. Within the portfolio, we do use some externally managed strategies. We know we cannot be good at everything. So we have to find who we think are really good investors around the world to partner with. Those relationships end up growing in size, and we too lean on them to lower their fees on behalf of our clients. Every year, it's part of the conversation. As our asset base grows with an external partner, we ask them about reducing our fees so we can pass that savings along to our clients. That's the only place it goes. So we're working on your behalf in that regard too. And the economies of scale definitely add up over time.
James, thank you so much. We're getting up to the top of the hour. If there are any questions that you had that we didn't get to, or if you think of any after this hour, please email them to me at either info@adamscountycf.org or serpe@adamscountycf.org. And I want to thank you all for joining us for the 2021 investment briefing. As you can see, we take investing in this community asset very seriously. If you or a philanthropy with which you're connected would like to create your own charitable fund at the Community Foundation and be a part of this endowment, please contact us. Let's talk about it. We're really ready for you to join us and to grow this permanent community asset that will be with us forever. Our thanks to Jim Kampstra at Kampstra Wealth Management here in Gettysburg, and James Stierhoff and John Price of Brown Advisory. We couldn't do this work without you. And on behalf of the Adams County Community Foundation Board, thank you for joining us. We really appreciate your time this morning. Have a great day.